All right, my name is Bronson. I want to bring you something funny today. What does Sean Connery call a greedy crab? Shellfish, right? So anyway, wanted to bring you some funny stuff because why not? Because stuff is sometimes too dense and we need to bring some humor to our lives. So we're seeing it today. What does it look like to be greedy when others are fearful? Some multifamily deals are challenging, face some challenges, capital calls, deals struggling, things like that. Investors are concerned. You may be concerned yourself. Inflation is higher, in my opinion, than reported. It's not 3%. I think it's more like 8% according to Shadow Stats. You can see here. And Warren Buffett, the best investor ever, in my opinion, he said this. He had all kinds of quotes, but one of his quotes was, "Be fearful when others are greedy, and be greedy when others are fearful." Well, what does that mean? How do you do that, especially in times of challenge? How do you manage yourself during a time of challenge? So we're going to go over that in 3 simple steps. I got a great quote for you at the end. Let's jump in. All right, so hello, my name is Bronson Hill. I'm CEO of Bronson Equity. We help by doing investment videos like this. We also have about $200 million in multifamily assets. We're doing ATMs, car washes, oil and gas, other things to help educate you to make better investment decisions. I'm not an investment advisor, so I'm not giving you specific advice. So investing is psychology. What does that mean? It means that if you're an investor and you lose your crap every time something doesn't go right, if you're Chicken Little and say, "Oh my gosh, the sky is falling, the sky is falling," and I tell you, most people don't think they do this, but there are many, many people, the majority of people do this, and it's, if that's what you do, then it's time to try to figure out how do you manage your own psychology. Warren Buffett was asked one time, what's the best temperament for an investor? What's the best quality, the character thing that someone has? And he said it's not a lot of, he could say a lot of different things. It could be intelligence, it could be just perseverance, a lot of things. He says, no, it's actually temperament, right? It's being able to manage your own emotions, your own psychology in the middle of it, which I think is a little shocking, but it makes a lot of sense. Investing is psychology. A lot of it's psychology. If things are crashing, instead of you dumping everything you have, which a lot of people do, it's saying, "Oh, I just have to have the money." If the business is still a good business, if the investment is still good, it's maybe time to load up or buy from other investors or find a way to do it. So this is something I think it's really important to take note of, that it's not just in stocks, it's also in real estate, it's in other things as well. It's important to manage your own psychology as you do that. So it's being able to go against the herd, right? That's really what this is. And what we call that really is contrarian investing. It's as if all the lemmings are going toward the wall, right off the cliff, and instead of stopping at some point saying, "Hey, well, everybody's going this way, maybe I should stop and I should go the other way." And it's easy just to go with the flow. We have kind of a default setting in our brains that's just like, "Oh, this is what everyone's doing, I'm just going to do it as well." But it's really important to think for yourself. It's really important to have your own process as you go about it. So for example, multifamily has been very in favor. It's been kind of the beloved child of the investing world, particularly the real asset world. And we were at times where we're getting 30 offers on the table for a specific deal. People are putting $1 million hard day one, meaning non-refundable. Now we've reached a point where rates have gone higher. We're actually seeing some pretty good deals. And now brokers are actually chasing us down, right? Because there are less people wanting to invest in deals. Some have gotten pinched in multifamily deals, either had a capital call or a loss, a potential loss, things like that. But in reality, it's not just to say, "Oh, well, this was good at the time." And again, we've had deals we raised $8 million in 24 hours for. And it was really easy to get people into deals then. But that was probably, looking back, not the best time actually to invest. The best time to invest is when no one else is thinking about it, right? And that's how people make a lot of times big money, and actually the risk is far less. So I would say for a lot of multifamily or other types of deals right now, the risk is actually a lot less than it was a couple years ago when rates were lower. And you say, "Well, how is that possible?" Well, valuations are down, so you can buy. Your buying price is fixed. You can always refinance later potentially, and that's how people make a lot of money. So I kind of grew up, kind of very middle class. My dad and mom were both teachers. We went to garage sales and thrift stores and all kinds of things. And I love getting a deal. I gotta be honest, I love getting a deal. And I've learned as I've become more wealthy that maybe it's not worth my time going to garage sales or thrift stores or things like that. But I still love getting a deal. I love getting shoes on sale. I love getting things that are of value, or buying a property that's at a discount, right? So that's really, when you're a contrarian, you're looking for value, right? Warren also says, price is what you pay, but value is what you get. Right? So it's not always a correlation that what you pay, you don't always get what you pay for. Sometimes you can pay half or a third or less than what something's actually valued. And that's what I'm looking for in investing. I'm looking for trying to take advantage of that. So we talked about, really out of favor investing, right? We've talked about multifamily and how it was really in favor. I want to share the story of a guy named John Templeton. He started a group called the Templeton Fund, which was one of the best performing mutual funds over years, or his as a fund manager. And he, in the Great Depression, many years ago, he bought all these stocks at a price earnings ratio of less than 10. Now, if you're not familiar with a PE or price earnings ratio, it just means how many dollars do I have to pay for $1 of earnings per year. So for example, if a price earnings ratio is 5, it means I'd pay $5 to buy this stock that produces $1 of earnings per year. That's pretty good, right? Today, the stock market is somewhere around between 25 and 35 is kind of common right now. So you're having to pay $25 to $35 for $1 of earnings. Well, this guy saw there was an opportunity, so he doubled down. He bought all these small cap stocks at single digit price earnings ratios, and he made a ton of money, both on the performance of those companies, but also he made it on the valuation, when the valuation changed as well. So again, it's when things are hot, it's important to consider start making your way to the exit. And when things are cold and no one's buying, it's important to, I think if you want to make money, to be able to really consider looking into that. One example of this is when oil after COVID, shortly after COVID, during COVID, was minus $37 a barrel. That means somebody would pay you $37 to take the oil off them because they had no more storage for this stuff and they were still producing oil. So it was difficult as a retail investor to buy oil at that price, but I was able to get into investment where I was able to make 2.5 times my money over the next year. And I saw an opportunity. I saw an out of favor asset. People think, oh, are people ever going to drive again? Is COVID ever going to end? And we wondered what in the world's going to happen. It was an incredible opportunity. So kind of as a summary here, understand your psychology. Don't be driven around simply by what's happening in the market. And when you have a reaction and you get afraid, really think through what's the crowd doing and what could I do that really, if something goes down in price, instead of selling, could I double down? Is the value still there for the investment? If the value is there, it doesn't matter what the current valuation is, right? Again, you have how much the investment is producing and what the prospects are, and then you have the price of what is paying. As Warren said, price is what you pay, but value is what you get. So if the value is there, if the price goes down, should you buy or sell? You should always be a buyer, right? Because things are now on sale. So consider that. I want to share this other quote with you from Buffett. This is kind of like Buffett video, I guess, Buffett week video here, but I want to share this with you. He said, widespread fear is your friend as an investor because it serves up bargain purchases. So Warren Buffett, apparently he likes bargains as well, right? He's described, wanting to get a dollar value for 40 cents. And again, it's an amazing way to invest, to be able to be a great investor and really be greedy when others are fearful. So I hope that for you. Hope you're able to do that. Stick in the comments below what you think, what you're finding of value now, how you're managing your psychology. Here's the best investing advice I've ever received. This video, you check it out up here. And also, if you haven't joined our investment club, you're not hearing about our awesome deals in multifamily, oil and gas, ATM machines, car washes, and other assets that we're looking at. And if you haven't checked out my new book, you can see a link below. It's called Fire Yourself here. I was able to fire myself from my great corporate job. And this gives you tips on how to do that, how to vet any deal. So thanks for taking the time to educate yourself. I look forward to seeing you on the next video.